Hello and welcome to the Single Family Rental Boom Continues webinar event hosted by Berkadia. The event is now live. Please note that all lines have been muted and will remain muted during the duration of the event. Without further ado, I'll turn the program over to Keith Misner.
Thank you. Hello, everyone, and welcome to Berkadia's 2022 Single Family Rental webinar. My name is Keith Misner, Executive Vice President and Co-Head of Investment Sales here at Berkadia. Thank you so much for joining us today as we take a closer look at the single family rental, or SFR, and build for rent, or BFR space, arguably one of the fastest growing segments in commercial real estate. We have the great pleasure of being joined today by John Burns, Chief Executive Officer of John Burns Real Estate Consulting. John founded the company in 2001 and is a leading research firm in the single family rental space. John and his team provide timely analysis and insight so their clients and subscribers can make the best decisions to drive profitable strategies. Following John's presentation, Jeff Coles, Vice President of National Client Services here at Berkadia, will moderate a Q&A session with John. However, before I turn things over to John, I just wanted to briefly touch on Berkadia's depth and breadth in the single family rental and build for rent space and how our team continues to be excited to drive opportunities and outcomes for our clients in this space. At Berkadia, we've taken a more coordinated and organized approach to SFR BFR properties over the past year, and as a result, have created a specialty resource to be more harmonized in our efforts. Berkadia's single family rental and build for rent specialty will have specific executive leadership via Jeff Coles, who you'll hear from later in today's webinar. With the increased appetite we're seeing from such a diverse range of investors, we want to make sure we're connecting to deliver the best and timelessly insights and acquisition opportunities to our clients in this space. Going forward, you'll see this branding on all SFR BFR listings from Berkadia. Berkadia was an early mover in the SFR BFR space. We began selling and financing SFR communities back in 2012, in fact. And most recently, our involvement accelerated over the past 18 months due to the demographic shifts boosted by the pandemic. In the second half of 2020 alone, so that's second half of last year, Berkadia's combined production volume on SFR BFR assets exceeded $400 million. In total, to quantify Berkadia's SFR BFR experience, Berkadia has sold and financed transactions on behalf of clients in the 20 largest SFR BFR markets across the United States, totaling approximately $2.75 billion. We're very much a major player in the space and excited to continue our momentum into 2022. With many investors shifting their investment strategies to include SFR and BFR properties, Berkadia's national footprint with unrivaled local expertise has never been more valuable, with presence in more than 65 markets coast to coast, as you can see on the map. Our local teams with deep market expertise, combined with Berkadia's cutting-edge technology and analytics, are set to deliver real-time actionable insights and advisory services to clients. Berkadia is truly equipped to finance and sell SFR BFR properties to generate the most attractive risk-adjusted returns for its clients in the growing housing segment. As many of you know, the single-family rental space isn't a new concept, but the space has become more sophisticated as more investors have entered the space over the past few years. Demand for single-family rental, or SFR, and build for rent, or BFR, properties has increased significantly, driven by changing migration patterns, as well as investors having trouble finding opportunities in other asset types where pricing makes sense for their targeted returns. Prominent home builders, including Lennar and D.R. Horton, have made the construction of rental houses a key component in their business model, while investment firms like KKR and Company and the Blackstone Group are allocating cash to this space. We also expect to see the crossover between multifamily and SFR BFR investors, developers, and third-party managers to continue. Overall, strong relationships, coupled with a broad range of capital sources, enable us to develop comprehensive capital solutions that fit our clients' needs. Here, I want to share with you a sampling of some of the clients Berkadia is working with on the SFR BFR space. And this list seems just to grow every day as more and more people are looking at our deals. As I mentioned earlier, the second half of last year, Berkadia's combined investment sales and mortgage banking production volume was over $400 million in the SFR BFR space. On this slide, I wanted to share with you a sampling of some recent SFR BFR investment sales transactions. Some observations we're seeing in this space. SFR BFR properties typically boast higher rents, higher other income packages, lower operating expenses, lower turnover rates, high availability of professional management, which is just like in the traditional apartments, which tend to produce higher values and frankly, more efficiency. SFR, BFR assets are often selling at similar cap rates as traditional apartments. Interest in our SFR, BFR listings have been extremely strong. The investor profile has been quite diverse, spanning from public REITs to private capital to institutional capital. On this slide is a sampling of our current SFR, BFR investment sales listings. As you can see, we're working on a number of assignments around the country. To learn about these listings and others we are adding probably almost on a daily basis, I encourage you to visit Berkadia's website, and once there, click on Properties. Now, without further ado, I'll pass it along to John Burns, CEO of John Burns Real Estate Consulting and an expert in the single-family rental space, to share his insights on the sector. John, as always, we really appreciate you being with us. Take it away.
Thanks. I'm living and breathing all of that as well. It's been quite a year, and we titled this last year the single family rental boom. This year it's the single family rental boom continues, but quite a bit has changed. So let me just tell you about how we're getting to where we're getting, and then we'll get into the good stuff. So we have a pretty diverse mix of clients all over the housing space. We're doing everything we can think of top down. We wrote a book on demographics. We're studying the economy. We're looking at the policy changes. There's more than 100 markets where we're publishing 70 pages of data, everything we can think of every single month, and throwing it in a dashboard and surveying all sorts of surveys. We bring the whole industry together 5 times a year, and we have a lot of trend reports too. We have a research service that last year a number of people listening to this subscribed, so thank you very much for that. And then we also have a consulting business, which I can't even keep this up to date. Last time I looked, we'd done 350 build-for-rent feasibility studies just in the last few years. So I want to give a little bit of history here on how quickly this industry is moving. And Keith talked about it being the hottest sector, maybe right behind industrial. I mean, it was only 10 years ago that American Homes for Rent got started and Blackstone came in, and it was a distress play. And then American Homes for Rent went public in 2013. By 2015, it was considered an emerging market. And then it was a matured business. And I'm talking about single family rentals, which are scattered homes. So 4 years ago, it was a mature business. That you go from distress play to mature business in 6 years is amazing. Look at the build for rent communities, which is really contiguous subdivisions. Think of them as an apartments, but a different type of living. In 2016, that's when we first started looking at some of these. We actually did one quite a few years earlier in Charlotte. But by 2020, people are looking for an inflation hedge. So it's a completely different reason that all the capital has been pouring in. And now there's so much capital in, it's really, this hedge has become a crowded trade, if you will. So there's still a lot going on, but I think the questions are different. The question 2 years ago was, what offers a positive yield and an inflation hedge? It's always been rental housing, and it usually means apartments, which is a mature industry, highly liquid. And this home for rent thing wasn't really as understood, but as I just showed you, it was maturing and the liquidity was improving. And boy, Keisha shows some amazing liquidity there. It's really improved. And the bet is this, and I know there's been some bearish conversations out there to be concerned about, but you know, with cash, where are you going to put it? The inflation at the replacement cost of the house, and we track construction costs. Every single part of the house that we can find is up 10% construction costs year over year, except one. Construction costs overall for the house are up 19%. So for those of you that were here last April in our webinar, we're doing an inflation hedge. This has played off really nice. And then I'll spend some more time on this lately, but if there's inflation and people are getting good raises because of it, we can raise the rents to offset whatever our expense increases are, and that's exactly what's playing out. So a little bit on the opportunity here. 15.7 million households rent a large apartment in a large apartment building of 10 plus units. That got a little messed up, I'm sorry. That's 13.3 million in a 2 to 9 unit building. 2.9 million in an attached home like Redwood builds all over the Midwest. I just got off the phone with them. And then there's these old homes that people have been renting. But look at the 12.3 million households. That's almost the same size as 10 plus units. And then there's some others. So why have we not been building anything new for the 12.3 million people that are renting households? That's the question. So I thought I would throw this out here because it's a little bit misleading. But single family renters still skew young. They don't skew quite as young as apartment renters, but homeowners tend to be older. So your target demographic here is 25 to 44, if you will. And the reason I want to point that out for build to rent is they're looking for new designs. And we have a subsidiary called the New Home Trends Institute that does a lot of design research and consumer research. And you know, these older homes that don't have work from home offices, or if they do, they're by the front door where the dog is barking. I mean, they're looking for different design. So that's part of the big play here is a new design. So here's the outline I put together for today, just 3 pieces. So brief review on last year, which was just an amazing year. We're calling this year a time to be more selective and strategic, and I'll talk a little bit about that at the end. And then the question I'm getting for those that want to get in the industry, should I build it, should I buy it, or should I just wait it out? So we'll get into all 3. So I went back actually, and I found this is still online. So the presentation I did last April is still online. You can look at it here or just Google Berkadia John Burns and you'll find it. A lot of the industry overview information is there, and I'm not going to repeat it again. So I want to let you know, if you're new to the industry, to check that out. So here's what's happened since then. Home prices, whether you look at our Burns Home Value Index or CoreLogic, Case-Shiller, or the NAR, have been up dramatically, 19% increase in home prices. I'm not going to stay political, and I don't set policy, but you can thank the Fed for some of this. The Fed now owns 24% of all the mortgages in the country. And I'm sure we'll talk later in the Q&A about the Fed raising rates. The Fed also owns mortgages, which you can see they never did before 2008. And they're talking about reducing their ownership of mortgages, which should cause mortgage rates to go up. So that's as important. I'm looking more at that than I am the Fed funds rate. I mean, they completely were very much behind this 19% price appreciation by buying rates down. And then also rents have boomed, but the numbers are all over the map. I mean, we roll things up one way, it's 5%. We rolled up another, it's 10. We rolled up another, it's 15. So I'm going to show you from our dashboard here what it looks like by market. These have come down a little bit year over year from 2 months ago. But 27 markets in the country have pushed rents 7% or more. Now, these are effective rents, if you will, on new listings. Renewals have generally been a little bit less than this. But 25 of those markets are in the South. So if you wonder why Berkadia has been so busy in the South, this is where the activity is. You go down to the next 27, those have had 4.5 to 6.8% rent growth. Probably keeping up with inflation, not the latest print on inflation, but those have all been great hedges as well. The green bar there is what the average is in the country. The average has only been 4.2 because there's so many homes in sleepier areas and with landlords who really don't push rents because they'd much rather have a stable tenant and they're afraid of occupancy. I mean, this is a real mom and pop business. And then there's 3 markets, San Jose and San Francisco would be the major ones where there's been a lot of outmigration and rents have actually fallen. So this is what I mean about being selective. This is not a national, well, it's a national opportunity, but it's playing out very differently. And then speaking of rent growth, if you're following what the 3 publicly traded REITs are reporting, the numbers I just showed to you look really tiny. Look, so I'm showing our rent index, and this is from a report we published a few years ago. Sorry, I didn't take the time, or a few months ago, I didn't take the time to update it. But at the time, Phoenix rents were up 14%. The 3 public companies have pushed rents 29% in Phoenix, one of their bigger markets. And look at that, 28 in Vegas, 22 in Tampa, 22 in Atlanta, 21 in Tampa. Big, huge pushes. Now they're institutional landlords who are very focused on raising rents, more on new, this is all on new leases, not on renewals. They don't push it as much on a renewal. I think they're proving out what we thought would prove out, but to a much bigger extent than I thought, that superior management matters. I mean, if you've been renting forever with a mom and pop landlord, not having anyone available when something's broken, living in fear they're going to sell the house out from under you and you're going to have to move, you don't have to do this with these guys because you know they're not going to sell the house out from under you. It's a better experience. And I also think they were very focused on lease up early on, and now they're pushing rents. So they maybe didn't push rents as much in the first place. So this chart has a lot on it. So it's the rent to income ratio by market, and it shows Cincinnati there at the top. What the history has been over the last almost 40 years. Cincinnati would have been 21 to 25%. The median would be right in the middle there, and the blue would be where it's at right now. Single family rent to income ratios are at all-time highs in some markets. You can see it's not in Cincinnati. The highest ever in Indianapolis, Las Vegas, Orlando, Tampa, and Riverside. So if you just looked at that, you'd say, well, I'd be concerned about those markets. But room to increase actually in some of these markets that have seen the strongest increases, like Nashville and Austin and Houston and Raleigh, Denver. And I will add, I think the income data that we have is too low. The raises have been so significant lately that the data is not keeping up with it. I'm a real bull on being able to raise rents. And that sounds a bit crazy, but let me show you some facts. So this is publicly disclosed data that's coming through the SEC, and these are huge sample sizes between the three companies here. I think they own 150,000 homes. So I just showed you how much they've been raising rents. Look at this. Invitation Homes, despite raising all those rents, our income to rent ratio is increased. So our tenants' incomes on our new leases has grown from 4.6 to now over 5. So their incomes are up even more than that. American Homes for Rent, documented incomes are up about 10%, which is pretty close to their new lease rate growth. Tricon, our rent to income ratios have remained stable. They're still really low, 22, 23%. I mean, the rule of thumb on a mortgage is 33, and FHA will go as high as 50. So I believe there's some room for these rent increases to continue, not only because the market allows it, but because the incomes are growing. Now, I know that can be a bit controversial because that's not true for every person in America, but this is a huge sample size. And I will add that all of this tends to be skewed to higher income tenants. The average income in those three portfolios is more than 100,000. And then if you look at the apartment market, just as some additional income growth evidence, same story. So RealPage gets a huge sample size on renter applications, and they've been tracking this for years. The people that are applying to rent apartments today have 12% higher income than the people that were applying to rent apartments a year ago. There's some income growth going on out there. And then let's look at some more at what the three publicly traded companies are sharing with us. 98% same home occupancy. You heard Keith say that there's not a lot of turnover. There's not a lot of turnover. And that's how you keep the occupancy really high. I think it's a 75-ish% renewal rate, even with a average about 6 to 7% higher rent. So 18% same home new lease rent growth. So that's when the home goes empty. They can jack the rent 18%. If you're going to stay put, they're pushing it 7, which is the record high for this relatively new business. Their margins have risen from 64 2 years ago to 66, so they're on the rise, and only 25% turnover. And if you look at the stocks of these two companies, Tricon just listed this year in America, they were in Canada. The market rewarded them. Last year, the stock prices were up 45%. So that's another way you can play this business, actually, is through the securities. There's actually a whole bunch of other ways you can play it too without actually taking title of the homes. And I'll have a little bit more on that later. So that's the amazing last year. This year, because of all that price appreciation, and because some of the craziness that we're seeing, particularly related to some locations, we're saying it's time to be more selective and strategic. Still very bullish overall, but not everything's going to work out. So here's the 3 reasons to be more selective and strategic this year. One is that the yields are down because not in every market, and particularly not for those public companies, but in most areas, prices are up more than rents, so yields are down. There is a lot of supply on the way. A lot. It's not going to show up by the spring. It is under construction and it is taking forever to build. The largest, D.R. Horton, just the largest public builder in America, just disclosed it's taking them 8 weeks longer to build a house than it did a year ago, and they can command all the labor and materials in every market they're in. So how long is it taking these small companies? Much longer. And then also far more competition, and not just from professional investors that are getting money through Berkadia. There's a lot of like meme stock investors are now coming in, and I'll show you a little bit about that, but I've got a lot of information on that. I'm not going to go through it. So here's some support for what I just said. Here's the single family gross rental yield. So this is income minus property taxes divided by the home price. It's down in the high 6s. You still have more expenses after that. And then the shadow supply of new homes under construction is the highest in 45 years. I mean, think about that. There's some really, really bad data that we busted a couple of years ago from NAR and CoreLogic and Freddie Mac and a few others saying we're 5 or 6 million homes undersupplied. It's totally wrong. But here's what we're seeing. So this is all the homes under construction, including permit that haven't really started yet, but not finished. Single family, there's 900,000 of those. I mean, that's not as much as during the 2006, but it's pretty darn high. Multifamily is at the highest since we've got this data back to 1975 of homes under construction that are going to be finished and vacant and need to be occupied by somebody. So we are going to see some supply. And when you add the two of them together, it's 1.7 million units. We wrote a book on housing demographics 6 years ago. We said over the next 10 years, due to the demographics in this country, we need about 1.35 million homes per year, including 100,000 units of manufactured. We've got more than a year's worth of supply under construction right now. And I'm seeing some crazy stuff. I'll just give an example of one conversation I had. Hopefully they're not on the call. Where there's 100 to 200 million that's going to go out of this particular company and build for rent development equity this year. They're quick close, no site visit. Those of us in real estate think, boy, that is a lot of risk. Those of you that maybe trade securities for a living say, well, that's more than I do when I trade GameStop. And I think that's the type of money that's coming in now is, they don't do site visits and typical due diligence, and they're not even taking title. A lot of the investment capital to the properties because they're investing in funds that are buying it. Here's one example. So I scraped this off their website, but this is a company I know, but I'm not disclosing who it is because I don't want to look like I'm pumping them up. But here's what they're showing investors. So more return in rental home investing over the last 20 years than the S&P. And here's what the co-founder and CEO shared, as you can tell on LinkedIn. In 24 hours, 1,000 people purchased 14 rental properties from them. So think about that. So too much of a good thing can turn into a good investment, or too much of a good thing can turn a good investment into a bad one. And here's one of those. So here's a home for what was that, $305,000 that 161 investors have already put $100 or more in, and there's 33,000 left that you can purchase. That's some of the capital that we're coming in right now that I know you're not used to, but that's a passive investor way to play this. and good diversification if you're looking for an inflation hedge. So I'm not saying this is crazy at all. I'm saying this is reality. And then with everything else that's going on, the stocks have, and most of the market is corrected, but the single family rental stocks have come off their top pretty significantly already this year. So that's part of the reason why I'm saying we need to be more selective and strategic. But let's talk about what that means. Are you going to build it, buy it, or wait it out? So income growth for me is the wild card here. I mentioned the income growth data is lousy, but I showed you some high sample size data that shows income growth is strong. I just got back from a CEO conference with a wide variety of CEOs where the stories I was hearing from on wage growth was pretty substantial. That tells me that if the government, if they believe their own data, isn't on top of this, and there's far more inflation than is being reported. So I showed you this chart earlier. 32% rent to income is the historical peak there. I think we can go higher than that. So this is my bullish thesis. I believe single family rental owners have the ability to push rents. I think incomes are higher than most people believe. We've got a lot of facts that I just showed you, proving that out to be the case. And that I actually think because of the high occupancy, rent to income ratios can go above prior peaks too, because people will pay more for a better rental experience. Now, this is a busy table, but I figured a lot of you are only in one or two markets and you'd want to look up your market here, so I'll leave it up for a minute. But the first column is the increase in home payment year over year in places like Austin, and this data is from a few months ago. And then the rent growth. Look how much more expensive it has become if you're interested in becoming a homeowner than if you're renting. So you may not like the 9% rent hike in Austin, but you definitely don't like the 35% mortgage payment hike in Austin. It's going to push more people to be renters. So building rental communities has become the hottest residential real estate investment, but it is much easier said than done. So we've been compiling this data because it didn't exist. And we continue to find more communities that are more mature. We're up to 651 built for rent communities in our database. 27% of them, though, were just built in the last 2 years. So this is a business that's growing very, very quickly. I mentioned earlier the costs of everything. If you're going to get into building, boy, you better hire somebody who knows how to build a house and knows how to get materials and knows how to negotiate. Look at framing up 19%, block up 8, lumber up 30. Who knows today? It could be up 10 or up 100, how volatile this is. There's a lot of risk in construction. But before you can construct the home, you got to buy the land. Land prices are up 17% too. And I get a lot of questions on the competition between build for rent and for sale home builders. This is what we're seeing. 9% of the finished lots in the Southeast are being bought with the intention of or built for rent, and it's about 6% nationally. And then this is why I'm saying you need to be super selective. Great locations are not easy to find. We've got clients that are trying to put $1 billion to work this year. You can't find $1 billion of good locations. You need to take some location risk. And here's one of the pitches that was quoted in a Bloomberg article earlier this year by one of my clients, actually. The outskirts of yesterday are the mainstream of today. Now that same market is considered close in. Now, I agree with that, particularly with this work from home trend. And I think that's behind some of the income growth as people are moving to new cities with their higher incomes and can easily afford something nicer. But you can't go super extreme. And I'll show you a super extreme example in a minute. And where I mentioned all these feasibility studies we're doing, I should geocode where they are so you can see it. But I thought this comparison just to a year ago would help you out. So we go through every market in the country. We did this years ago, and we graded every submarket, an A, a B, a C, a D, and an F, with a discipline that 20% of the people live in an A, 20% in a B, 20% in a C. So that's my discipline here. A year ago, the build for rent locations, 25% were in A markets, 29% in B, so 54%. And you can see only 3% were in F markets. Today is up to 5% in F. The D markets have gone from 18 to 22. So we are seeing more and more of that location risk. I thought that would provide some good clarity for you. Some of the conversation would make you think that 100% of everything that's going on is out in the outskirts. That's not the case. In fact, what we're seeing is people going to small markets where there's not a lot of activity and finding an A and B location. So there's some of that going on as well. Here's one deal that was had some active fundraising on and we were not involved in that I thought I would share, but this is in Locust Grove, Georgia, outside the outskirts of Atlanta. I mean, the more affluent areas are up in the triangle in the north. And this is a high density townhome product, but a quick Google search just says this is not a great area, but we are seeing some of this crowdfunded like capital go out and fund projects in these areas. So it's not all one thing. If you're scared about building this because you've been doing apartments forever, you probably should be, because some of the public builders know how to build it very efficiently. They're all in. So D.R. Horton is building it on their own and selling them. They expect to generate $700 million in revenue from rental property sales in this year. Lennar formed a massive joint venture with Centerbridge and another entity, $1.25 billion in equity plus debt on top of that. They've got the Lennar teams all over the country who really know how to build great homes, building it for them. Toll Brothers has a partnership with BB Living. They were one of the first ones in with BB Living. Taylor Morrison has partnered up with Christopher Todd Communities. They're building luxury build-for-rent communities. They're more like there's no attached garage. These are more like a resort-like small home living. LGI is more of a, we're not building subdivisions, but we'll sell 10 to 12% of all the homes we build to somebody. I mean, they are at the very low end of the income range, and they get a lot of people who want to live in an LGI home but can't qualify for the mortgage. So there's a massive tenant demand of people that want to live there. And so they're selling it directly. Pulte was the last big builder here really to join the party, 7,500 home partnership with the largest publicly traded company, Invitation Homes. Progress Residential might even be larger now, and they're private. And then K. Hovnanian is doing it too. So all the public builders are in this game. This is a map of the 651 communities with some density summaries. You see a lot of one-level row homes in the Midwest. I think what do they call that? Suburban universal living, I think is what Redwood calls it there. It's more like paired homes. In the Southeast, you see a lot of detached housing, single family. You see a lot of the orange, the horizontal apartments in Arizona. It's a very different product. When those attract different types of tenants too. And it's a super fragmented industry. Only 7 companies own 1,000+ units. There's been some that have built more than that, but they've sold them. 330 companies in that 651 communities. That's less than 2 communities per owner. And then if you look at it, Phoenix, where I know Berkadia has a huge presence, there's 52 build-for-rent communities there. That's been dominating it. That's the market that's more likely to get overbuilt. We're seeing a lot proposed in Buckeye and Casa Grande. I mean, Casa Grande is a truck stop on the way to Tucson. I'm sorry if you're investing there. And it probably could handle 1, but not 10. There's some risks being taken. So the question is, do you build it? Do you buy it? Or you wait it out? And I'm going to chicken out a little bit here on the answer. Because I think I'd have to ask you some questions first. It depends on your appetite for risk and your willingness to invest in the industry actively or passively. So it's not a one-size-fits-all. So with that, I'm done listening to myself, and I'm looking forward to some great questions so I can learn from you. And if you do want the slides, just email me, jburns@realestateconsulting.com. Colby Fitchin may get back to you with that, and I'd be happy to share with you. And I'm looking forward to the questions.
Thanks, John, for your perspectives. Now, I'm excited to close out the program with the Q&A session. We received over 75 questions from our participants ahead of today's webinar. We will cover as many as we can, and then we will be sharing responses to those questions that we do not get to cover on Berkadia's social channels. So be sure to follow us if you do not already. I'll get started with the first question. Are single-family rental developers competing with public builders such as Toll Brothers, Pulte, etc., for raw ground in high-cost markets? If so, how does this impact growth of this sector?
Build for rent tends to be higher density pieces of land. So in something where Toll Brothers is going to build one of their beautiful 4,000 square foot homes, you're not competing with Toll Brothers for that one. And something that might be 10 or 12 to the acre that Toll Brothers might be doing something else, or probably more likely a Lennar, you would be. We are seeing instances now where we run the math for our clients, and there are certain instances where the exit strategy is the single family rental buyer will pay more for the house than a consumer was, but that is very location specific. So the answer is yes, but it's on far less than half of the land deals out there, and I showed you it's 9% in the Southeast right now.
Gotcha. Thanks, John. Much appreciated. Second question: will the impeding FOMC rate hikes have an impact on the boom?
Well, that's a better Berkadia question, because I think it has something to do with the interest cost. I mean, the borrowing cost, you know, if the yields are going down and the cost of borrowing is going up, that's not going to be great. But at the same time, I think that is, and it's less the increase in rates, it's more the planned decline in mortgage-backed securities that purchases that is going to drive mortgage rates up, which is going to increase demand. So I guess the answer is your borrowing costs would go up, but there's going to be more demand for the rental homes. So it's kind of a wash.
Thanks. Well, hopefully this one will be directed a little bit more towards you. And the question is the boom a fundamental shift or temporary condition?
I think there's a fundamental shift going on. I think every city in America that has at least 1,000 people renting homes can use a new subdivision. At the same time, I think there's so much capital trying to go in so quickly that they're going to the Locust Groves and Georgias and the Casa Grandes, Arizonas, and I think there's a bubble forming there as well too. So I'm all in for this over the next 20 or 30 years, but I think there's some frothiness going on.
Great. Well, with that, we'll bring our discussion to an end. A special thanks to John for sharing his valuable insights. As a reminder, a recording of this webinar will be available shortly. As always, please do not hesitate to reach out to any Berkadia professional with questions or follow-up. She or he will direct you to the right resource and get you the answers and insights you are seeking. We are here for you. Here.